Welcome to this explainer. Today, we're diving right behind the neon curtain to uncover something wild, the silent, high-speed transition from human finance to the fully automated machine economy. We usually talk about AI and cryptocurrency like they're totally separate things, right? Just operating in their own little silos. But what we're actually witnessing right now is a massive back-end infrastructure collision. AI protocols are literally crashing headfirst into decentralized ledgers, and it's creating this huge structural requirement for the biggest portfolios on the planet. So let's get into exactly why AI software agents, which are operating completely without human oversight, are now mechanically mandated to use decentralized assets like ADA and TO as their core settlement fuel.
Think about this for a second. When an AI over in Germany needs to instantly buy data from a server in Singapore, what currency does it even use? This question perfectly captures the cyberpunk reality we're living in right now. When autonomous software needs storage, compute power, or data, it absolutely cannot wait 3 to 5 business days for a bank wire. It doesn't care about bank holidays and meat space, and there's no way it's waiting around for a human to hit approve. These machines have to transact across borders 24/7, continuously, at the speed of light. It really makes you realize that our traditional financial plumbing simply wasn't built for non-human actors. So, to figure out what currency they actually do use, we kind of have to rethink our entire definition of a financial system.
And that brings us to this fascinating concept, autopoietic networks. It's a bit of a mouthful, but the term actually comes from biology. Think of a biological cell. A cell just takes in resources through its wall, and then it automatically assembles its internal structures based on its own DNA. It's completely self-creating and self-producing. Now, take that exact concept and map it onto this new machine economy. We're looking at vast, decentralized networks like Bitcoin or Cardano that govern and sustain themselves purely through network consensus and algorithmic execution. There's no CEO, there's no central foundation calling the shots. It's just pure engineering beauty, a whole system governed by code and math. They are completely, 100% autopoietic.
Section 1. The rise of the AI agents. See, the AIs we're dealing with today aren't just generative chatbots spitting out text replies. They are action-oriented workers. Take a modern AI model like Sylvia, for example. It uses what's called multi-agent orchestration. So if you ask it to run a complex financial scenario, it doesn't just guess or scrape a web page. It orchestrates a whole team of specialized sub-agents. One agent runs out and grabs real-time market data. Another one is literally writing custom Python code in a secure backend to run a 20,000-path Monte Carlo simulation. Then yet another agent takes all that output and generates the visual charts. It is superhuman intelligence independently executing incredibly complex workflows. But here's the catch. To pull this off, these subagents desperately need rapid, continuous microtransactions to pay for API calls, bandwidth, and processing power. And as they get smarter and more autonomous, they hit a massive roadblock.
Which leads us to Section 2, the machine settlement problem.
When you look at traditional securities, you're looking at a system totally bogged down by human-managed regulatory baggage. For the massive tech companies running these AI models, the corporate liability is just way too high. Securities carry enormous legal risks, and they rely on these centralized entities that act as single points of failure. An AI agent simply can't take on that kind of legal risk, and it definitely can't operate efficiently if it has to wait on KYC delays or central database approvals. Commodities, on the other hand, they are the perfectly legal, compliant fuel these corporate AI models actually need. Commodities are permissionless, they are completely borderless. There's zero central point of failure, and nobody runs the market for them. Because of this stark contrast, autonomous agents are mechanically mandated to use decentralized commodities. The assets just sit out there on the network, ready for algorithmic consumption. Section 3. The corporate legal shield. Now, this is exactly where Cardano steps in a way that I think most of the market completely missed. During the Voltaire era, the network achieved this undeniable, sheer level of decentralization. The original founding entities permanently surrendered the Genesis keys. They literally handed ultimate control over to the community of node operators. And honestly, it is brilliant when you think about it, because no single entity or foundation controls the chain anymore. It legally functions just like a commodity. Think of it like gold. Nobody owns gold, nobody runs the gold market, it's just managed by the people participating in it. This decentralization wasn't just a technical upgrade, it acts as a corporate legal shield. It is literally code acting as an impenetrable legal defense, allowing massive corporations to utilize the network without constantly stressing over securities violations. And there's a specific number that is absolutely vital to that commodity status: 45 billion. That is Cardano's unalterable hard cap. You can't print more of it, and you can't inflate it. Now, you might be wondering, why on earth does an autonomous AI agent care about a hard cap? Well, it's because algorithms rely entirely on predictable, unalterable math. If an AI is out there running risk algorithms or doing long-term systemic modeling, fiat inflation fundamentally breaks its models. In a meat-space world where fiat currencies are just constantly being debased by central banks, a hard cap provides the absolute mathematical certainty that machine logic desperately needs to function safely. Add to that this absolutely staggering figure, $1.7 billion. Remember that autopoietic concept we talked about earlier? Because of how Cardano's node operations and consensus are structured, every single transaction feeds a built-in treasury owned by the community. That treasury is currently sitting on roughly 1.7 billion ADA. It is a massive, self-funding war chest. While other blockchain projects are out there begging venture capitalists for money, who then eventually just dump their tokens on retail investors, this network is completely self-sufficient. It pays for its own development and its own infrastructure autonomously. If you're techie, a self-funding decentralized protocol is pretty much the ultimate cybernetic organism. It basically guarantees the system will still be chugging along 50 years from now, totally independent of human fragility.
Let's move to Section 4, ADA and TAO, machine fuel. We are officially crossing the threshold from humans sending money to each other to machines sending money to each other. Thanks to the X42 protocol, Cardano is transforming into the foundational settlement layer for these AI software agents. ADA is basically becoming the digital industry's equivalent of oil or copper. It provides the lightning-fast, cheap, and strictly regulated settlement fuel that machines need to pay each other seamlessly. Just picture this, neon cyberpunk reality. While all of humanity is fast asleep, thousands of servers around the globe are silently exchanging micropennies of ADA. They're authenticating data, they're buying bandwidth, and executing incredibly complex algorithmic contracts. Guys, this isn't speculative trading. This creates a massive, utility-driven baseline demand that has absolutely nothing to do with retail traders staring at candlestick charts on their phones. It is pure, raw, structural utility.
Let's break down the actual throughput fuel of decentralized compute networks like TAO. To put this into perspective, if we look at a theoretical $10,000 capital deployment into this sovereign accumulation engine, and assuming TAO is priced at $1,000, it can independently generate an annualized yield throughput of over 2.5 million satoshis a year. That's incredible. We are looking at a mechanical necessity that's expanding across the broad machine network. These accumulation engines just run entirely in the background. They are fully automated, directly converting machine utility and compute bandwidth into hard digital wealth, day in and day out, without a single ounce of human intervention. This whole shift is summarized so beautifully by this quote from our sources. The silent transition from retail hype to corporate necessity. While you are sleeping, Cardano became a structural requirement for the biggest portfolios on the planet. That really hits the nail on the head. We are witnessing a totally unglamorous, strictly mechanical reality of adoption. It is no longer about chasing retail hype. It's about structural, mathematical necessity underpinning the very next phase of the internet. Section 5. The passive index trap. Believe me, the titans of Wall Street have completely recognized this legal and technical reality. Look at the multi-asset filing from T. Rowe Price, a firm that manages over $1.5 trillion. They specifically carved out space for Cardano as a core commodity component, literally pairing it right alongside hard assets like gold. Meanwhile, Grayscale locked in an 18.33% large cap allocation. And you know what the profound irony of all this is? The traditional Wall Street suits are being forced by their own passive algorithmic rules to buy into this decentralized machine fuel. The majority of the money in the world isn't even traded by emotional humans anymore. It's managed by passive indexes. Trillions of dollars are moving around based purely on cold, hard index rules. Let's break down exactly how this plays out on the institutional side. We call this cycle the passive index trap. Step 1. Retail traders feel a bit of fear during a market dip and emotionally sell their assets, which drops the price. Step 2. Massive passive index algorithms instantly detect that their portfolios, like Grayscale's 18.33% allocation, are suddenly mathematically underweight. Step 3. This triggers a clinical, lightning-fast rebalancing, forcing a massive automated buy order across the entire network. And finally, Step 4. The institutional algorithms silently gobble up all that available supply created by the retail panic. The lower the price goes, the more they are mathematically forced to buy. They aren't trying to time the market, they don't feel fear, they are just algorithmic executioners blindly following the math. Which leaves us with one final, vital thought. The era of speculative retail tokens in meat space, it's quietly closing.
It's being replaced by regulated corporate commodities acting as the literal fuel of our digital future. As algorithmic precision and autonomous AI agents clinically absorb the foundational layers of this entire new economy, the smart money is just quietly securing its position in the background. So, while the machines silently buy up the new digital gold, what are you doing with the time you have left?